It's been a theme of ours from the beginning of the year, and especially initially the short end of the U.S. yield curve has been what we were focused on. It was our view that the Fed was going to continue to raise rates rather quickly, and that in fact that the long end was going to be anchored to some extent by global factors. That is, still active QE in China, in Europe. And so we've had short rates volatility, we've had long rates volatility, and when one turns off, the other has tended to turn on. So we don't expect the long end of the U.S. Treasury curve rates to go above 3.25, but we do expect the speed of the changes in rates, especially on the short end, to be what to look for into the end of the year, and that will be a headwind for equities in our view.
So David, match that up. You've got the headwind of rising rates with what appear to be better corporate results. Most companies are beating earnings. P&G this morning was a real surprise on the upside. And mostly better economic data, except for some housing numbers, like the one that Diana just brought, which missed.
Well, good morning, Sarah. I think, to put it all in perspective, we've had 200 basis points of rate hikes this cycle. We've seen the balance sheet contract from a peak of 4.6 trillion down to 4.2 trillion. We're losing 50 billion a month, so there's an embedded tightening. Fed's very likely to go in December and maybe a couple times next year, give or take. Maybe it's 1, maybe it's 3, maybe it's 4, we don't know. But we're talking about a cycle with what looks to be at least 300 basis points of tightening built into it. So I'm thinking that's quite a lot. That's the type of cycle we had in 1994, which managed to blow up a lot of things by the end of 1994. So I'm not sure that I would say things are, that rates have a long way to go from here. I think we're getting very much toward the end of this, and I think the market's a little bit maybe off in how it's reading the Fed.